Ever thought about making your money work for you rather than you working for money? If so, then investing in the stock market might be your answer. Now, I know what you're thinking. The stock market sounds complex and intimidating, right? Well, it doesn't have to be. Especially if you're young and have time on your side, the stock market can be a fantastic way to grow your wealth. We're talking about turning spare change into a substantial nest egg. Sounds good, doesn't it? And the best part, you don't need a finance degree to get started. Today, we're going to walk you through the basics, breaking down the jargon and making this seemingly complex world of stocks and shares simple and accessible. We'll guide you on how to navigate this world step by step. By the end of this video, you will have a basic understanding of how to start investing in the stock market. Before you start investing, it's crucial to understand what the stock market is and how it works. So, let's break it down. The stock market is like a colossal global marketplace, where you can buy and sell ownership shares in companies. These shares are known as stocks. Imagine it like an auction house where buyers and sellers negotiate prices and make trades. Companies sell stocks to raise money. They could use this money to expand their business, develop new products, or pay off debt. When you buy a stock, you're essentially buying a piece of that company, making you a shareholder. As a shareholder, you have a claim on part of the company's assets and earnings. Now let's talk about something you've probably seen on the news: fluctuating stock prices. The price of a stock is determined by supply and demand. When more people want to buy a stock than sell it, the price goes up. When more people want to sell a stock than buy it, the price goes down. This is influenced by a myriad of factors, such as the company's financial health, economic conditions, and investor sentiment. Investing in stocks can be exciting, but it's not without its risks. The stock market is volatile, meaning it can go up and down frequently. If you buy a stock and its price falls, you lose money. But remember, you only realize that loss if you sell the stock. If you hold on to it, the price might go back up. However, the potential rewards can be substantial. Historically, stocks have provided some of the highest returns of any asset class over the long term. If you invest wisely, the stock market can be a powerful tool to build wealth. Keep in mind that investing in the stock market is not about making quick cash. It's about growing your money over time. It requires patience, discipline, and a well-thought-out strategy. Now that you have a basic understanding of the stock market, you're ready to dive into the actual process of investing. Just remember, every investor started where you are right now. So, let's take the next step together. So, you've decided to invest in the stock market, but where do you begin? Well, first things first. Before you dive headfirst into the whirlwind of the stock market, it's crucial to set clear financial goals. Are you saving for retirement, a down payment on a house, your child's education, or simply aiming to grow your wealth? Having clear goals will guide your investment strategy and determine your risk tolerance. Now, once you've got your goals in line, the next step is to choose your investment strategy. Are you aiming for a passive approach with index funds or ETFs? Or do you prefer an active approach where you pick and choose individual stocks? Remember, there's no one-size-fits-all strategy here. It all depends on your financial goals, your risk tolerance, and the amount of time you're willing to dedicate to managing your investments. Next up, you'll need to open a brokerage account. This is essentially your gateway to the stock market. Now, there are dozens of brokerage firms out there, each with its own set of features, fees, and minimum deposit requirements. Some cater to beginner investors with user-friendly platforms and educational resources, while others cater to more experienced investors with advanced trading tools. So, take the time to compare different brokers and choose one that aligns with your investment goals and experience level. Now here comes the fun part, choosing the stocks to invest in. This is where your research skills come into play. Look at a company's financial health, market position, and growth prospects. Pay attention to trends in the industry and the economy as a whole. And don't forget to consider the stock's price. Is it overvalued or undervalued? This will help you determine whether it's a good buy or not. Once you've set your goals, chosen a broker, and done your research, you're ready to buy your first stock. But remember, investing is not a get-rich-quick scheme. It requires patience, discipline, and a willingness to learn. So take it slow, start small, and gradually build your portfolio as you gain more experience and confidence. Purchasing one stock isn't enough. To reduce risk and increase potential returns, you'll need to build a diversified portfolio. Let's delve into what diversification really means. Picture yourself at a buffet. Instead of piling your plate with just spaghetti, you add a bit of salad, a slice of roast, some fruits, and maybe a small dessert. Why? Because you want a balanced meal that satisfies various tastes and nutritional needs. That's diversification in a nutshell. It's about spreading your investments across different types of assets to balance risk and reward. Now, why is diversification so important? Imagine investing all your money in one company's stock. If that company tanks, so does your entire investment. But if you spread your investments across various stocks, sectors, and even countries, a single company's poor performance is less likely to sink your whole portfolio. Diversification, in essence, is your safety net in the unpredictable world of investing. So, how do you build a diversified portfolio? There are a few strategies to consider. First, spread your investments across multiple asset classes. This means not just investing in stocks, but also in bonds, real estate, and potentially even commodities. Second, diversify within each asset class. Instead of investing in one technology stock, consider investing in a few from different sectors like healthcare, utilities, and consumer goods. Third, consider index funds or exchange-traded funds, or ETFs. These are ready-made diversified portfolios that track a specific index, such as the S&P 500. Lastly, rebalance your portfolio periodically. Over time, some investments may perform better than others, skewing your original asset allocation. Rebalancing helps you maintain your desired level of diversification. Remember, diversification isn't about chasing the highest returns. It's about managing risk. It's about creating a portfolio that can withstand market volatility and generate steady returns over the long term. Building a diversified portfolio can help you weather the ups and downs of the stock market. Investing isn't a get-rich-quick scheme. It requires patience and regular monitoring. Now, let's delve into the essence of long-term investing. It's about playing the long game, holding on to your investments, and allowing time to do its magic. It's not about timing the market, but time in the market that matters. Regular portfolio monitoring is also crucial. It's not about obsessively checking your investments every day, but rather keeping an eye on your portfolio to ensure it aligns with your financial goals. Here's a golden rule to remember. Avoid panic selling during market downturns. It's natural to feel anxiety when the market dips, but remember, these downturns are typically temporary. Selling out of fear could mean missing out on potential gains when the market recovers. So keep calm, stay patient, and let your investments grow over time. Remember, investing is a long-term game. Patience and regular monitoring will ultimately lead to success.